Three index funds do the work most investors spread across a dozen. For nearly every investor heading into 2026, those three cover everything the other 8, 10, 12 funds in the account were supposed to add, and holding more actively erodes the return, quietly, year after year. The cost is not abstract. An investor owning 8 overlapping funds instead of 3 loses tens of thousands over a lifetime, not to a market crash, but to hidden overlap, tracking drag, and the churn of a portfolio that feels diversified and isn't. It never shows up on a single statement, it shows up in the ending balance. Which raises the question this video exists to answer. If owning more funds feels safer, why does every extra fund make the average investor poorer? Over the next 20 minutes, the math gets named. 3 fund categories, each justified by its own arithmetic, and the exact point where a fourth stops helping. Almost no one stops at 3, and the reason is a habit, not a strategy. Open the Average Investing app in 2026 and scroll the Holdings tab. It rarely reads like a plan, it reads like a timeline. A total market fund bought first, back when the account was small and the advice was simple. Then, a large cap growth fund added after a good year made growth look inevitable. A dividend fund, purchased the month a paycheck felt less certain. An international fund because a headline warned that America couldn't lead forever. A small cap fund because someone credible said small caps were due. Each one entered the account on a different day, for a different reason, and none of them felt like clutter at the time. That is the pattern worth naming. Nobody sets out to own 12 funds. They arrive one decision at a time, each decision sensible in the moment it was made. Consider a composite investor. Call her a 41-year-old with a steady salary and a retirement account. She checks more than she'll admit. She is not reckless. She reads. She rebalances. When she adds a fund, she can explain exactly why. This one covers a gap. That one hedges a risk. This other one captures a corner the first fund might miss. Every purchase has a rationale she could defend to a friend over coffee. And that is precisely the trap, because a rationale is not the same thing as a benefit. Here is the insight the collector's instinct hides. Adding a fund feels like adding protection. Psychologically, it registers as coverage. One more base touched, one more thing that can't hurt you now. The account grows longer, and a longer account feels sturdier, the way a fuller toolbox feels more capable even when half the tools do the same job. The mind counts holdings and reads safety. It almost never counts overlap and reads redundancy. So the behavior isn't stupidity, it's the opposite. It's diligence pointed in the wrong direction. The same care that makes someone a good saver. The impulse to prepare, to not get caught unready, is the impulse that fills a portfolio with funds that quietly duplicate one another. Responsibility, expressed as accumulation. And it scales. Once the frame is, more coverage is more safety, there is no natural stopping point. There is always another gap a salesperson or a headline can name. Emerging markets. A sector fund for the technology you use every day. A low volatility fund for the years you'd rather not lose sleep. Each edition answers a real-sounding worry, and each one arrives wearing the costume of prudence. The investor ends the decade with 14 funds and the calm sense that she has been thorough. What she cannot see from inside the app is that thoroughness and diversification are not the same thing. 2 funds can carry different names, different fees, different marketing, and hold underneath mostly the same 500 companies in mostly the same weights. On the screen they look like 2 decisions, in the market they behave like one. That gap between how the portfolio looks and how it actually behaves is where the money leaks. But the leak isn't visible yet, because at this stage nothing looks wrong. Every fund is justified. Every purchase was defensible on its own, which is exactly what hides the problem. Look under the hood of that 14-fund account, and something strange happens. The names stay different. The holdings stop being different. This is where the leak that Block 1 promised, the tens of thousands lost to overlap and drag, finally becomes something you can see. Start with the mechanism, because the mechanism is the whole story. A total market fund holds the entire US equity market, weighted by size. That means roughly a quarter of its money already sits in the same 15 or 20 giant companies that dominate every other domestic fund on the market. Now the investor adds a large-cap growth fund, believing she's tilting toward the future. But those growth names, the biggest technology and consumer platforms, are already the top holdings of the total market fund she owns. She hasn't added exposure. She's doubled a bet she already placed. Then the dividend fund arrives. It screens for established, cash-generating companies. Many of those companies are, again, the same mega caps sitting at the top of both funds she already holds, just filtered through a different label. The S&P 500 fund she bought for stability overlaps the total market fund by something close to 85% by weight, because the largest 500 companies are most of the market's value to begin with. 3 funds, 3 rationales, 1 underlying portfolio wearing 3 costumes. Here is the relief. This is not a character flaw, and it is not rare. Researchers studying what they call the diversification illusion have documented it repeatedly. Investors given more fund options spread their money across more of them, believe they've reduced risk, and end up with portfolios statistically almost identical to a single broad fund. The instinct is universal. The math simply doesn't reward it. Knowing that lifts the guilt. Nobody outsmarted this person. The structure was built to feel like progress. But relief is not the destination. Here is the revelation the calm can't soften. Overlap doesn't merely fail to help, it actively costs. Every one of those redundant funds carries its own expense ratio, and the specialized ones, growth, dividend, sector, low volatility, charge more than the plain broad market fund doing most of the same work underneath. So the investor pays a premium to own a second, third, and fourth copy of exposure she already had for less. Then comes tracking drag. Niche funds trade more, rebalance more, and lag their benchmarks by small margins that compound. And then the quiet one, behavioral churn. A portfolio of 14 funds gives an anxious investor 14 things to tinker with, 14 reasons to sell the laggard and chase the leader, precisely the activity that studies tie to underperformance. Add it together and the picture inverts. Each new fund was purchased as protection. Each new fund, in the aggregate, added cost, added trading, added the illusion of control that invites more trading, while adding almost no new diversification, because the underlying companies were already owned. The thing bought as a shield turned out to be a small recurring tax. That is the answer to the question this section owed you. Each new fund feels like protection, because the mind counts holdings and reads safety. Each new fund quietly adds risk, not market risk, but the drag of fees, redundancy, and the human urge to fiddle with a portfolio that gives you too many buttons to press. Which means the real portfolio was never 14 funds, it was 3 or 4 distinct exposures, buried under a pile of expensive duplicates. Strip away everything that overlaps, and what remains is startlingly small and startlingly specific. Strip the duplicates away, and what survives isn't a mystery. It's 3 exposures, and each one earns its place with arithmetic the redundant funds could never produce. Start with the first, a total U.S. equity fund. The number that matters here is not its return, but its cost. Roughly 3 to 4 basis points at the cheapest end in 2026. That figure hides something most investors never calculate. Owning the entire domestic market at 4 basis points means paying about 40 cents a year per $1,000 to hold every public American company, weighted by what the market itself decides they're worth. Compare the scenarios. A large-cap growth fund charging 30 basis points to capture the same top-heavy giants cost roughly 7 times more for exposure already inside the broad fund. Recalculate over 30 years on a $200,000 balance, and that spread alone. 26 basis points, compounding on money that grows, quietly subtracts a 5-figure sum for exposure the investor already owned. The broad fund isn't cheaper by a little, it's cheaper by a multiple for the same companies. The second exposure, total international. Here the number that matters is correlation, not price. US and developed foreign markets don't move in perfect lockstep. Over long stretches, their correlation sits below 1, which is the entire mathematical reason to hold both. What that hides is why so many investors skip it after a decade of US dominance. They look backward, see America winning, and conclude foreign stocks are dead weight. But the case for international isn't a prediction that it wins next. It's that the two together produce a smoother path for a given return, because when one lags, the other need not. Run the scenario where US valuations, elevated going into 2026, revert toward their historical mean, the exact environment where a home-only portfolio suffers most, and the international sleeve stops looking optional. The math justifies it precisely when it feels least necessary. If that inversion, that you diversify most in the years it looks pointless, reframes how you see your own account, the like button is the quiet way to tell YouTube more investors sorting this out should find it. The third exposure, bonds, size to the investor rather than the market. The relevant number here is duration and yield, and in 2026, both finally matter again. After the long stretch when bonds yielded almost nothing, a broad aggregate bond fund now pays a real coupon, meaningful income, and a genuine cushion. What that hides is the mistake investors make in the other direction, reaching for high-yield or long-duration funds to squeeze more, and importing exactly the volatility the bond sleeve exists to remove. Compare a plain intermediate aggregate fund against a portfolio stuffed with credit risk bond products. The recalculation is unforgiving. In the drawdown that bonds are meant to protect against, the exotic bond funds fall alongside stocks, defeating their only job. The math rewards boring here more than anywhere. 3 funds: total market, total international, aggregate bonds. Between them, they hold, on any given day, tens of thousands of securities across every sector, every size, 2 continents of equity, and a broad ladder of debt. The 14-fund portfolio held fewer distinct bets than this. It just wore more labels. That is the answer to the question this section owed. Can 3 funds really hold everything the other 9 promised? They can, because the other 9 were never 9 bets. They were 3 bets, purchased repeatedly at rising cost. The 3 do the diversifying, the extra funds only did the spending. Notice what the arithmetic per fund shares. Each recommendation rests on a number that doesn't depend on forecasting, a cost multiple, a correlation, a coupon. None of them asks the investor to be right about the future. That's what separates a defensible fund from a collected one. 3 covers the map, nearly the whole map, because there is exactly one honest case where a 4th fund earns its keep, and it isn't any of the ones already in the account. Here is the fair objection, the one a careful investor raises the moment someone says 3 funds are enough. If 3 is the answer, why does almost every serious portfolio, pension funds, endowments, the models built by people paid to know, hold more than 3? Surely the professionals aren't just collecting. Surely there is a 4th exposure, a 5th, that the arithmetic actually rewards. That objection deserves its strongest form, not a straw man, so build the best version of it. The steelman goes like this. Total market, total international, and aggregate bonds cover the vast middle of what an investor can own. But they leave a genuine seam. All 3 are weighted by size or by market value, which means each one leans, by construction, toward whatever is already large and already expensive. A total market fund is a quarter mega-cap growth, whether the investor wants that tilt or not. And there is a body of long-run evidence, documented across decades of academic work, that certain slices behave differently enough to matter. Small-cap value in particular has historically carried a return premium and a correlation to the broad market low enough that adding it changed the math, not just the label. That is not a sales pitch. That is a real, cited, defensible case for a 4th fund. A small-cap value fund is arguably the one addition that buys exposure the 3 core funds genuinely underweight. Notice what makes this exception legitimate. It clears the exact bar the collected funds failed. It isn't a second copy of the mega-caps already owned. Its return driver is distinct. Smaller companies trading cheap relative to their fundamentals, a corner the cap-weighted funds structurally underrepresent. Its correlation is low enough that, in the years the giants stall, it need not. It rests on a premium measured over 90 years, not on last quarter's leaderboard. If any fund earns a 4th slot, this is the shape of the one that does. Now the rebuttal is not that the 4th fund is wrong. It's that the 4th fund is almost never what people actually add. Watch the composite investor from earlier reach for number 4. She does not buy small cap value, the one exposure her 3 funds genuinely lack. She buys the large cap growth fund, or the dividend fund, or the sector fund covering the technology she already owns 4 times over. She adds the thing that feels exciting, not the thing the math is missing. Because the missing piece, small and cheap and unloved, is precisely the piece that never makes headlines. The fund that earns its place is the boring one. The funds people collect are the thrilling ones. And even the legitimate 4th fund comes with a warning the honest version has to state. It only pays if the investor holds it through the long stretches where it lags, and small cap value can lag the broad market for years, sometimes a decade, before the premium shows. An investor who adds it and then abandons it after 2 disappointing years has bought the volatility without collecting the reward. The exposure is defensible. The behavior it demands is the hard part. So the exception proves the rule rather than breaking it. There is a real 4th fund. It is specific, cited, and structurally distinct, and it is almost never the fund the account collector actually buys. The urge that fills a portfolio with duplicates reaches, when given the chance, for one more duplicate. Which means the problem was never the shortage of a good 4th idea. It was the surplus of bad ones dressed as diligence. So why does the account collector always reach for the exciting fund and never the missing one? The answer isn't in the market, it's in a set of experiments that have nothing to do with money at all. Start in a grocery store. In one of the most cited studies in behavioral economics, researchers set up a tasting table with jams. On some days, they offered 6 varieties. On other days, 24. The larger display drew more curious shoppers to stop and look. More attention, more interest, the retail equivalent of a longer holdings tab. But when it came time to actually buy, the result inverted. Shoppers facing 6 jams purchased at roughly 10 times the rate of shoppers facing 24. More options pulled people in and then paralyzed them. Abundance looked like generosity and functioned like a wall. That is choice overload, and the finance version is quieter but structurally identical. Give an investor a menu of 40 funds and something predictable happens. They don't analyze 40 funds and select the optimal 3. No one can hold 40 comparisons in working memory. So they use a shortcut the researchers documented directly. They spread money across more of the options, a little into many, and read that spreading as prudence. Follow-up work on retirement plans found the same fingerprint. As the number of funds offered rose, participation and coherent allocation fell, and the portfolios people built looked less like decisions and more like a hedge against having to decide. Here is the lesson buried in the jam. The urge to add one more fund is not greed, and it is not ignorance. It is the mind doing exactly what it does when facing more choices than it can rank. It stops choosing and starts collecting. Collecting feels like acting. It relieves the discomfort of the open question, "Am I covered?" without ever answering it. Each new fund is a small dose of relief from the anxiety of an undecidable menu. The portfolio grows not because the investor concluded she needed 14 funds, but because 14 small reliefs were easier to buy than one hard decision to stop. A second finding makes this worse. When people are handed more options, they don't just choose poorly. They grow less satisfied with whatever they chose and more prone to second-guess it. The larger the menu, the louder the suspicion that the better fund is the one not yet owned. Which is the engine of churn. The collector is never finished, because the very abundance that produced the last purchase guarantees the next worry. Sit with that for a moment, because it reframes everything the earlier math exposed. The overlap, the drag, the duplicated megacaps, those were the symptoms. The disease was never a failure of analysis. It was a nervous system responding, rationally and predictably, to more choice than it was built to hold. And this is the turn. The intervention that comes next is not a lecture about willpower. Willpower loses to a supermarket display. It will lose to a brokerage menu too. The only thing that reliably breaks the pattern is understanding the pattern, seeing the urge as a documented reflex rather than a personal verdict about being underprepared. Knowing why the urge exists is what finally makes consolidation possible, not shame, recognition. Consolidation sounds like subtraction, and subtraction sounds like loss. That framing is the last thing standing between the collector and the corrected portfolio. because on the day someone sells 9 funds down to 3, it feels like giving something up, not getting something back. The screen gets shorter. The instinct reads that as exposure removed. It almost never is. Here is what recognition changes. Once the urge is seen as a reflex rather than a verdict, the sell button stops feeling like a confession of error. Nobody was wrong to buy those funds. They were responding, sensibly, to a menu built to overwhelm. Consolidation isn't undoing a mistake, it's declining to keep paying for one. So follow the corrected arithmetic on a concrete case. Take the composite investor, 14 funds, roughly $200,000. A blended expense ratio dragged upward by the specialized products to somewhere near 35 basis points, plus the churn of a portfolio that gave her 14 things to tinker with. Collapse it to 3. Total market, total international, aggregate bonds, at a blended cost near 6 basis points. The exposure barely moves. The same tens of thousands of securities were already underneath. What moves is the leak. Nearly 30 basis points recovered every year, on a growing balance, plus the trading she no longer does, because there is nothing left to second-guess into. Compare the two scenarios over 30 years, holding the market's return identical for both, because that is the honest comparison. The underlying bets were always nearly the same. The only variable is the drag. A 30 basis point difference, compounding on a balance that grows towards 7 figures, does not stay small. It widens into a 5-figure gap, and in the higher balance scenarios, a low 6-figure one. Money never lost to a crash, never lost to a bad call, only lost to owning the same companies 3 times at rising cost. The tighter portfolio didn't take more risk to earn that, it simply stopped spending on redundancy. That is the application, and it scales down as cleanly as it scales up. A smaller account recovers a smaller sum, but the same proportion, and it recovers something the arithmetic can't price, the end of the open question. 3 funds can be understood in a sentence. There is no laggard to chase, because each holding is the whole of its category. There is nothing to add, because the map is already covered. The anxiety that bought 14 funds has nothing left to buy. Which finally answers the question this video opened with, the one left standing since the first minute. If owning more funds feels safer, why does every extra fund make the average investor poorer? Because safety was never the thing the extra funds added. They added cost, duplication, and buttons to press, while the actual diversification was finished at 3. The feeling of safety and the fact of it pointed in opposite directions, and the account paid the difference quietly for decades. If this kind of math helps you decide what to keep and what to let go, subscribing is how you catch the next breakdown. There is a new one every other day. So the question stands as plainly as it can be asked: 14 funds that feel thorough, or 3 that can be defended with arithmetic? Which portfolio do you actually want to own? Wealth is built to last, and it is built by owning less than the urge demands. This is education, not personalized advice.